For more on the biggest story shaking up Wall Street, I want to bring in Eddy Gifford. He's a financial advisor at Tactive. Eddy, it's great to see you this morning. Happy holidays to you and your team. And as we get started here, I want to take a look at the state of play, especially as today, even the day before the holiday, is going to be big on the economic front. What do you see?
Well, we're looking at everything, and everything feels good right now, and that's a good thing, because there's been this worry that's been lingering for a while, and that's typically a good thing when it comes to markets, but it can be too much of a good thing to where people just finally say, no, I'm out. And so in general, like, we're seeing like good feelings, but the issue is that we still run into the data that we've been up against all year. We run into the fact that, you know, inflation has been like the #1 and primary target by the Fed. Well, that recently ticked up for the first time in a long time. We're looking at jobs, which have been good, but they've been revised lower multiple times and appear to be slowing down. And then we look at housing, the thing that everybody has been saying, oh, it's going to go up forever. Well, hey, that was, you know, new homes were just revised down. And so when we look at all that stuff, it does give us like cause for concern, or at least pause, and saying that, hey, like, the data isn't exactly showing up the way we want it to. It doesn't mean the market's going to go down, but it means that we should be paying attention to what's happening, because if housing stays at least stubborn, that's not good for inflation. If energy continues to rise and there's a lot of demand for energy, that's not good for inflation. And if inflation has 2 ticks up in a row, that could cause the pause to be like, hey, gradual is going to become nothing. And if gradual becomes nothing, we could see another 2022 all over again. And that's where the bond market and the stock market got beat up. So yeah, we're quietly and cautiously optimistic, but at the same time, we're ready just in case something breaks under the surface.
Interesting. So when it comes to the tactives, Eddy, what are you recommending your clients?
So, you know, one thing is you got to lean into the trend, and so the trend has been up. We bought Bitcoin right before election day. We've owned the markets with the Nasdaq and the S&P 500 for a while, and we're going to lean into that trend as long as that trend is there. Of course, in any given day, that trend can fizzle, and if that happens, that's where we need to have offsets in the portfolio to make sure that when things turn, we've got something that's working against us. You know, I'm one of those rare advisors that says that we actually need to have red on the statement every quarter, because that means that we actually do have a diversified portfolio. So just making sure that anything we buy, we have a reason to sell it, and anything we buy, we have some type of offset in the portfolio. Those are the main things that we're always trying to do, regardless of the situation, because things happen. And as long as the data continues in the trajectory that it's on, we're sitting in a good spot. But as we know, when stuff happens, it happens suddenly. And it's kind of like that whole escalator up, elevator down thing. And we want to protect against that elevator down.
What is it about crypto, Eddy, that is attractive to your firm?
Well, crypto in general, I think that is very, very, very new, especially in the investor space when it comes to the institutional side of things. Obviously, retail has been pushing it for a long time, but when you look at kind of the foundation of crypto, which is Bitcoin is very intriguing in general, just because of the old school supply and demand story. Everything that we've ever learned when it comes to finance and economics, that, you know, when I studied it in college, it was supply and demand is going to be the driver of return. And with Bitcoin, we have a finite number of Bitcoins. And so we know that over time, the supply and demand story will be strong. So right there, that makes us at least interested in including it in the portfolio. But when you take it a step further, the adoption of Bitcoin has been slow. And so although a lot of retail has been jumping in, institutions just got into the mix this year. And as we see more adoption, that should drive the price up also. And so when when a lot of people aren't using it and there's a finite number of coins and it's already doing well, and then people start to use it, even if it's not for like the original base case, which was, hey, a way to transact anywhere across the world, now people are thinking of it in terms of an investment. And because of that, we think that there's a lot of upside, albeit the volatility is a lot higher than most are used to. So that's the thing that really, I think, scares a lot of mom and pop and advisors in general, because a 10% move in a day is not unheard of. It's almost common.
Eddy, we have a lot to get to, of course, over the course of this next hour, including that market open. We'll check back in with Eddy just after stocks are open for trade. That's Eddy Gifford. He's a financial advisor. All right, rejoining me now, as promised, is Eddy Gifford, financial advisor at Tactive. Eddy, it's great to see you. We're off to the races. Relative calm here, of course, before Thanksgiving Day tomorrow. I want to get a sense from you, as you look at the data, what the state of the consumer is.
Well, the consumer seems cautious. When we look at like what's been happening with inflation in general, and then we've got obviously PCE up today, what we've noticed is that at least for the last few months, the consumer's been cautious. A lot of the spending has been driven by debt, unfortunately. So those are the things that have really stood out. Now, on the back end of the election, a lot of the people that we've been talking to, they seem more confident. I don't know if that's going to translate into spending into the holiday season or into Black Friday that we know is upon us. But those are the metrics that we're going to be paying close attention to over the coming weeks to kind of see like, okay, do we have more confidence, or are we really going to start leaning in again? Because consumer sentiment still has been getting revised down. It still has not been what we expect from and expectations or from a current conditions standpoint. So that is the primary focus, because at the end of the day, if the consumer doesn't spend, then the businesses aren't profitable. And so that has to be the focus.
It's interesting, Eddy, of course, as retail earnings wind down. We have heard from several major retailers, including department stores, and it does show, in fact, that last quarter consumers were willing to spend, specifically on items like clothes and shoes. They might have pulled back on electronics, but certainly they are deal hungry and wanting to capitalize on that. And so I think that's a takeaway collectively that we can view from some of our NYSE listed companies here. When it comes to growth and your forecasts on growth ahead, how much does the Fed's rate path factor into that as we await that December decision?
Well, I think the rate path is less important than how the bond market perceives that rate path, because the rate path in and of itself, that helps consumer lines, that helps home equity lines, that helps those types of things. But what it doesn't help is it doesn't help the car loans, it doesn't help the mortgages, the fixed mortgages, it doesn't help those things. And so we need the bond market to be convinced by the Fed that things are getting better. And if we see that and we start seeing the long end of the curve start to come down, that's where we really potentially see some acceleration on the growth side of things. We just don't want it to happen too fast, right? They're playing this Goldilocks game right now, and we got this teeter-totter thing going on. And if all of a sudden the Fed has to cut rapidly because something broke, well, that means that we're in recession. But if the Fed can cut gradually and the bond market can build confidence in the Fed over that same timeline, that means that we can have another great year next year.
Mm-hmm. And what would you categorize as a great year, both for the economy and for stocks in terms of metrics?
Well, it's hard to compete with the last 2 years because we've had these 25+% years back to back on the S&P 500. So I think that if we get anything over 10%, 10 to 15% on the S&P, that would be a good year. From an economic standpoint, we just want to see that inflation continuing to fall. We want to see GDP kind of heading in the right direction. Of course, there probably are going to be a few abruptions there from the standpoint that the administration is planning on making some adjustments, and change usually makes things go a little bit backward before it goes forward. But when we look at it from like a long view standpoint, we think that just kind of being a little bit ahead in the economy at the end of next year, and then like a 10 to 15% move up in the S&P 500 over next year, we would consider that a good year.
Come January, of course, January 20th, the new administration will be in the White House, and we saw a red sweep, of course, after Election Day. How does that factor into your thesis?
Well, it definitely factors in from the standpoint that we're going to become a lot more choosy when it comes to investment and focus more on sectors like energy and even specific stocks, from the standpoint that when you're all red or all blue, the broad market actually doesn't perform as well. But certain sectors do. And so we'll be paying closer attention to certain sectors that tend to do well with the red administration. We do think that because it's all red and because there are some potential big changes on the horizon, volatility is still not going to go away, not quite yet.
You know, I do want to ask about geopolitics. Eddy, we started the show, of course, with the news that we heard from President Biden yesterday. Oil prices, we know, are closely aligned with what we see happening on the international front as it relates to geopolitics. What do our viewers need to know on that front?
Well, I mean, the less conflict, the better, obviously. If we can get some peace across the board, that's going to be good because oil prices will continue to stay low or even fall further, which is good for the inflation story. Of course, if conflict escalates, that's when we start to see a little bit of fear and that's when we see oil prices rise. And honestly, like it's been interesting. That's where we've seen Bitcoin rise pretty rapidly when conflict seems inevitable. So looking at oil or looking at like Bitcoin as a hedge against conflict and also as a hedge against inflation, but then also just understanding that like we don't want those, we don't like it when we have to have those hedges in the portfolio because that means the other stuff is not looking so good.
Eddy Gifford, financial advisor at Tactive. Eddy, great to see you on the show today. Have a happy Thanksgiving.
Appreciate it. Thank you.